Good morning. You're watching The Market right here on 80 now with me, Aisha Faridi, Nikush Dalmia, Avan Dabash in the studio, and Antara Rai as well joining in on the show. And while the markets did what they did yesterday, held up nearly about 2% at the session highs and then saw a big crack coming in from there. I think the big news that's going to impact the markets more than anything else today, as were the local factors in trade yesterday as well, is the fact that Adani FPO has been called back. And I think that group of shares, Nikunj, were the reason which I guess the markets fell yesterday, and today that's going to be the key story.
You know, Aisha, the market got much more than what they wanted in terms of an budget.
Yeah.
And the market reaction, despite the fact that institutional investors were not big sellers, that's what data is indicating, was purely because of technical factors. And the technical factors largely because Adani group of stocks, they sold off, it created a domino effect. And then HNI investors and FNO traders, they pretty much decided to throw in their towels. So there were technical factors which were at play, and the technical factors really broke the back of the market, and a great budget like what we saw yesterday was completely ignored by the market. Now I was hoping that there would be some logic and some rationality which would come back after yesterday's technical sell-off, but now we'll have to really understand and take this Adani FPO withdrawal news forward, and that in a sense will have implications on the market, at least in the short to medium term, because these group of stocks will remain volatile. And it needs to be seen that how markets essentially are able to digest this kind of a news flow.
Yeah, and it also sort of throws open a lot of questions now which are unanswered. Why was the FPA called off when it was fully subscribed? Yeah. What happens to people who've put in the money, the lenders first? Yeah. And then, of course, the collateral damage on the shares, if there is to be any.
So, Aisha, they'd moved mountains. They'd move mountains to take so that for the issue to go through, and the issue did go through, largely because of support coming from some family offices and also some Middle East funds. Now the question is, why have they decided to return the FPO money, I beg your pardon? You can argue and say that this is in the spirit of investor interest, because the underlying price of Adani Enterprises is almost 50% lower than the FPO price. So, to protect the long-term investor interest, the spirit I think is right. But since this is an equity offering, you have to understand that the purpose of the FPO, when the FPO was floated, it had a purpose that it will fuel the high growth businesses of the Adani group, which is the green hydrogen business and the airport business. And it will also help the debt reduction of the company, and it will increase the equity base and also change the debt equity ratio. Now that the FPO proceeds are going to be given back, what will happen to the capex, debt reduction plan, and the entire high growth businesses of Adani Enterprises, which in a sense are the business of the future. So the high growth, high capex which the Adani group currently is planning obviously will take a back seat, and they will have to revisit and understand that if the FPO proceeds will not kick in, the plan which in a sense, the capital structure plan which in a sense was drawn, and the capital and the growth which was coming largely because of this FPO money, what will happen to that growth? That's part one of the story. Part two of the story, the lenders. Now this is one equity issuance, so there is no bank risk here. The State Bank of India chairman yesterday told us that they have no problems. I mean, Adani exposure is not a problem for India's biggest lender, and that account is that account interest is completely served. But from a market standpoint, since there are some dollar repayment bonds which are dollar repayment bond which is due now on some dollar bond, markets would be observing that with huge amount of curiosity as to what happens. I think from a market standpoint, if today some of the lenders they sell off, that would be a sentimental reaction. I don't think there is a problem per se for the Adani Adani loans, but from a market curiosity, the bond repayment which is later this month, I think would be of immediate curiosity. So there are two factors here. Sandeep Tandon also joins us now. Sandeep, good morning. Thank you for joining us. The Adani Group moved mountains, Sandeep, to ensure that the FPO sails through, and it did sail through. But they've decided to return the FPO proceeds. What do you think has triggered this move? What do you think would be the thought here?
To be candid, generally, Nikoj, is very difficult to predict how particular entrepreneur is thinking and what is the board thinking is all about. The only message for market is very confusing, okay. It lacks clarity and market hates uncertainty. Okay, the clarity is needed. Okay, if you keep on changing your strategy, and that is the way market doesn't like. Okay, and I think that's the reaction which you are seeing in the market. Okay, but again, Nikon, this sort of things we have seen n number of times in various point of time. Last 30 years, I have seen many such moments. Okay, but as long as assets are, if the group is backed by assets and other thing, I think it's a temporary phenomena. It can come back, but ultimately it affects market sentiments, and which is the case in current environment. But let's focus on the good thing. The budget obviously is very, very constructive. Okay, all the concern which we had all about the capital gain changes which market was worried about. In fact, market is the way budget has come out is a step in right direction. It has addressed all those worries. So narrative which was getting built about the taxation aspect, people were nervous, okay, and the risk appetite on Indian equity market which was declining relative to global thing. And we have seen some amount of sell-off happening from the ETF player or the passive money moving out. I think sometime you get a buying opportunity also. We are seeing a good amount of capitulative move happening because of this event unfolding. I think real capitulation happened on the side effect in the banking side, where our data and the quant capitulation index has spiked significantly in the banks. Okay, so which clearly indicates it's like today, tomorrow type. In next one or two trading session, banks should bottom out. So I will look such events sometimes gives you extraordinary buying opportunity in the sectors or stocks which you like. I think banking is another opportunity which is and given the physical discipline the budget has showcased along with the growth momentum, I think this opportunity, that's the way I look at from the market, because India, both from a structure and long term, looks very good to me. So these are the great opportunity to accumulate the stocks which you want to build in your portfolio.
Oh yeah, absolutely. There's no denying that. But Sandeep, tell me what happens to the Adani group of stocks now that the FPO has been called off? Because, speculation is rife in the market that considering Adani Enterprises share price is much below the FPO price now, maybe people would jump in to buy into the stock considering the long-term growth prospects of the Adani Group and especially Adani Enterprises continues to remain intact. But there is the other theory also, considering the group was already very highly leveraged. There is already that pressure of foreign investors selling into Adani bonds, whether the stocks are going to crack further. What do you think is going to really happen with Adani stock shareholders now? What should they expect?
See, it is generally we don't comment on stock specific thing given this noise which is there. Okay, I think sentiment definitely has been affected, but we have everybody has to take a call. Whether these stocks are or some of the stocks are backed by assets or not, whether they are backed by cash flows or not. Okay, so it's not like the entire basket is bad. Some of the names are very, very good in that. So it's up to individual and every portfolio manager how they perceive as whether it's opportunity or whether people think other way. So the way I look at, I will look this as a buying opportunity for market in general. Particularly, I say because of this event, banking has affected a lot. Okay, where is no damage is going to happen in the banking. I don't see any crisis for any of the banking, whether it's private sector or public sector. So I will use this as an opportunity to buy banks. So if I have to really conclude, instead of getting in particular stock specific thing, I think the much larger call will be to participate in the banking names which has corrected significantly. And everybody in generally has been positive about the credit uptake which is happening, and budget is also a supporter in that direction. I think it's a right time to increase our banking exposure. That's the way I look this as opportunity. So one way of looking about worried about the crisis which is happening, I said In last 30 years, we have seen n number of times of such opportunities, okay, or such crisis, whatever name you want to call it. Somewhere market also gives you opportunity to participate. So either one should. So I always talk about narrative can be very different, and that can lead to good amount of fear or capitulation, which is getting built in the market right now. Other way is looking at this is a great opportunity to buy Indian banking names, which has corrected significantly 10 to 20% correction, which we have seen in some of these names. So that could be a great opportunity.
I'm just going to close it up with one final question on the budget. There are two casualties in the budget if I look at the budget fine print. First is insurance and second is luxury housing. There are almost 6 insurance stocks listed. Insurance stocks yesterday really got cleaned out. What's your view there, given that you do have exposure in some insurance stocks?
See, Nikunj, to be candid, yes, it was a big blow. Because the first reaction market has showcased. The initial reaction is bad. But we have to keep in mind that from a longer term perspective, the way India is growing and disposable income is growing, both insurance as well as mutual fund industry are sunrise industry. Okay, so there can be small setback on immediate basis. Again, we are talking about only the premium segment above 5 lakh rupees or so. So there is a psychological impact. There will be some amount of earning impact also. We are not ruling out. But given the opportunity which it has, given the potential which has from a longer term perspective, I think I should be a buyer in these names if it corrects further. So I will, yes, short term negative, but from a very constructive, from a longer term perspective, I don't think we should write off these sector the way market has reacted yesterday. So it's a near jerk reaction which is happening. So again, opportunity, whether is one has to say whether it's another 5% lower, another 8% lower, or another 3% lower, that's a question of time. But I will look for a buying opportunity in the insurance space also. But these are all best of the companies which is available at good valuations. And they have been correcting not just one, not last 1 year. If you look at the private sector, insurance has corrected a lot. So they are already reaching their neglected zone. So I will look for a buying opportunity rather than saying that one should be too dejected what has happened in the yesterday's budget.
Okay, now we've got a big mega exclusive, Gautam Adani, on why they have decided to return the FPO, return stroke refund FPO proceeds. Gautam Adani, mega exclusive on ET Now.
After a fully subscribed FPO, yesterday's decision of his withdrawal would have surprised many. But considering the volatility of the market seen yesterday, our board strongly felt that it would not have been morally correct to proceed with the FPO. In my humble journey of over 4 decades as an entrepreneur, I have been blessed to receive overwhelming support from all stakeholders and particularly the investor community. It is important for me to confess that whatever little I have achieved in life is due to the faith and trust reposed by them. I owe all my success to them. For me, the interest of my investor is paramount and everything is secondary. Hence, to insulate the investors from potential losses, we have withdrawn the FPO. This decision will not have any impact on our existing operations as well as our future plans. We will continue to focus on timely executions and delivery of projects. The fundamentals of our company are very strong. Our balance sheet is healthy and assets robust. Our EBITDA levels and cash flows have been very strong and we have an impeccable track record of fulfilling our debt obligations. We will continue to focus on a long-term value creation and growth will be managed by our internal accruals. Once the market stabilizes, we will review our capital market strategy. We have a strong focus on ESG, and every business of ours will continue to create value in a responsible way. The strongest validation of our governance principles comes from several international partnerships.
Okay. 3 parts to it. What will happen to Adani stocks today? What will happen to Adani's future growth businesses? What will happen to banks sentimentally? I don't think anything changes there. And then the markets. So I'm going to discuss the 4th part, markets. Markets sold off yesterday, despite a good budget. FIs were net buyers. Domestic institutional were net buyers. My guest, Basant Maheshwari, before asking him, I'm guessing that he was a buyer in the market yesterday. Am I right, Basantji?
No, we are already loaded, and when the market falls, we can only console each other and say, "Bhai, koi baat nahi, ho jayega, theek ho jayega."
So what happened yesterday?
Like we say normally, Bhagwan sab theek karega. That's what we say, but we don't keep cash normally, Nikunj, as you know. So whenever the market falls, all you can do is feel a little bit of pain and trauma and then move on in life. So that's the way it is.
What led to the market decline, and who sold yesterday? I mean, FIs were net buyers, DIs were net buyers, budget were great. SIP investors will not change their heart, but somebody sold. The selling in Adani group of stocks was excruciating. The reversal in banks was painful. So what triggered the fall yesterday?
I think, Nikunj, what we normally used to say, that the retail joins in last and doesn't influence the market. Maybe I think the retail got panicky after hearing all the Credit Suisse reports and started selling. I don't know, because the institutional figures were positive. So these days it's the retail. So you don't know if one guy sells 200 shares from one dealer and there are 10,000 dealers across the country, then you don't know the power of the retail. So, but these things are not of much relevance right now, because I think what is more important is the overarching fear on the market about what's going to happen next to the banks and other things. So the retail and HNI, which earlier were like second or third fiddle to the entire market, they've become very dominant forces now. So I think that's one point to consider with. But broadly, I think we are not participating in the global rally. That's my biggest fear and pain right
now. Adani group of stocks, they moved mountains to ensure that the issue goes through, which it did. They were supported by family offices and some funds in Middle East. But the fact that Adani Group has decided to withdraw the FPO and refund the proceeds of FPO, what do you think that indicates, and what do you think it will do to the future growth plans of Adani Group of companies? Because there was a reason why you went and raised capital. It was to reduce debt and to incubate high growth businesses. What happens now?
I mean, it's very basic arithmetic that if you don't have the money, you cannot grow as fast. But the group says that they will manage it, but the market doesn't believe. The price on the screen doesn't believe. The price on the screen says that I don't know what's happening. So I think that's the big difference of opinion that's running right now. And I think the way this entire thing has happened, it would have been better had they got the money rather than they not getting the money. Because if they don't get the money, then again the stories will start from America and from Europe, from a bank in Europe and from a research agency in America about the different problems that the company is facing. So I think the basic underlying problem was leverage, and they had to deleverage. So earlier they deleveraged better for them, I would say.
Right. But Basant, what happens to shareholders? You know, because Adani Enterprises share price is now sub the FPO price. I mean, do you see buyers now at this kind of value? And does the stock now in the interim go on a spree of upper circuits as opposed to what it has been in the last 2 days? Or do you think it's going to be the other way around?
The stock will go upper circuit, but I really don't know about that. We wouldn't buy. We have not bought Adani. So for the last several months, I mean, whatever you can want to look at it, we are not investors there. And we wouldn't normally like to buy something which is clouded with so much of controversy right now. So once it stabilizes, then people can go and take a hard, long look at some of the businesses, maybe their port business or maybe their cement business. But for now, what happens is when there is confusion and chaos, the arithmetic price earnings ratio, cash flow, business model, execution capabilities, nobody wants to listen to that because people are more worried about the near-term impact. And in the near term, I think the market is blind. It can do anything to anyone. So the stocks went up, the stocks are coming down. No one knows the reason for either of these two things. So I would think that it's better to actually sit back and take a long, hard look rather than think that these are businesses I would like to own or these are businesses I would not like to own.
Basant, in the current market fall, I'm curious to understand, and let's now shift the focus and tone of this conversation away from the Adani Group. Have you been a buyer of late, or do you think there's enough panic on the street and you want for the dust to settle down?
No, to wait for the dust to settle down because yesterday's Fed commentary was quite convincing because the problem was in the NASDAQ. The problem was in the Bitcoin. So I'm not suggesting you should go and buy Bitcoin, but Bitcoin has rallied 50% and Bitcoin is the best indicator to where interest rates are going. The NASDAQ is a best indicator because the NASDAQ has long-term growth stocks. So if you see the NASDAQ is recovering, the NASDAQ is moving up, but the Dow isn't participating as such. So the new economy names, the companies that are going to deliver growth for the next 3, 4, 5, 7, 10 years, the ones which were beaten down last year when the Fed started hiking rates, those kind of companies are doing much better relatively in US. Still they're down 40, 50, 60% from the top. So I think the writing on the wall is clear. Once we get over with our internal issues of different corporate houses and banks and the insurance bill in the budget and other things, I think we should also participate and join the global rally. But I think what happened was we ran ahead of ourselves and then we started patting ourselves on the back saying that India is decoupled, our time has come, we're going to show the world. And then suddenly we realized that nothing's decoupled in this world.
It isn't, right? It's all connected. Basant, always great having you on the show. Thank you so much for taking the time out. Okay, let's quickly recap what the setup this morning is looking like, what the SGX Nifty is up to, because as I see on my screens, we're already staring at a downtick of about almost 1%, 17,560, and it's a triple-digit cut coming in. But what happened yesterday, given that FIIs, DIIs, both were buyers who sold, the fact that after that 0.5% uptick to start off trade with on the index, and that mammoth move coming in on the index post-budget with stocks on a tear along with the Nifty Bank, it all came crashing down and we finally closed in the red. If we can just have yesterday's Nifty graph, closed in mildly soft post-adjustment, but at the session lows, it was a 0.5% downtick coming in. Kunal and Naresh are here with us as always. Kunal, Naresh, good morning. Not the best of morning, as was the afternoon yesterday. Whatever happened?
Yeah, I think it was a bit of a head over heels kind of a day for the market. It's very difficult to try and trade in such kind of scenario, but my experience tells me that such are the kind of days where there is extreme amount of volatility, more of sentiment based rather than more of volume based panic which happens into the markets where major bottoms could be made. Now 17,400 has been technically tested twice when we look at the last 1 week, 10 days of price action data for the Nifty. Yes, intraday the Nifty went below the 17,400 mark, but then the fact that we recovered, we could probably keep that as a benchmark support for the index. Now looking at the global data points, looking at the setup, I believe sooner than later we should be in course for forming a major bottom for the indices over here. So the view is not to go short on the indices over here, but to try and use these 140, 150 point dips in case if it opens in that kind of a magnitude for the indices as a very good opportunity to try and go for a contra buy on the index.
Okay, contra buy on the index is what Kunal is suggesting at the moment. Charts indicating that we may very well be near a bottom. Naresh, coming to you now. Good morning. The day after Union Budget, we all saw yesterday what happened, the budget rally being killed by the carnage that we saw in the Adani stocks. What are the levels that you're watching out for today?
So for the Nifty, 17,300 to 17,500 remains an important band. That is where the rally started from in October. Also, we have the 200-day moving average and multiple supports around this area. And in the last week, we've tested this zone for a couple of times. So closer to 17,450 to 17,500 is where you want to actually buy. Keep a 150 pointer stop loss. And if this plays out, we go back to 18,000. Structurally, the two major events are out of the system. You have the budget done with, the Fed done with. So in that case, we have this scenario, either we go quickly to 18,000 or we start making a consolidation between 17,400 to 18,000, and it could be a slow move on the upside. But overall, at 17,500 levels, it becomes a risk reward buy for the Nifty. For the bank Nifty, we would wait a little because that has been a little more volatile, and say closer to 40,000, 39,800 is where you want to buy with a stop loss at 39,500.
All right, let's find out some top recommendations as well from our charters going into trade this morning. And Kunal, what's it that you're tracking today?
See, my belief is that most of the large cap names should make a very strong comeback. And I think when the market needs support for larger cap stocks, these are best times where you'll see performance coming from the erstwhile leaders. So two buy calls which I would suggest. First is a buy on HDFC Limited. That stock is looking quite strong and attractive. In fact, yesterday also was one of the best movers, at least till the mid part of the session. Even in the fag end, the stock could maintain its positive price data point for itself. So that's a buy. Targets of 2,760, stop loss at 2,600. And the second would be a buy on ICICI Bank. So I'm changing my stance from being a bearish on ICICI Bank to now starting to get into a buy zone. I think the stock has completed that mean reversion, completed the classic retracement towards the 200 moving average, and also the retracement towards that 800 mark. So keeping all of that factors in mind, would suggest a buy on ICICI Bank. Targets of 888, stop loss 828.
Right. Okay. Naresh, what's on your stock list? Buy, sells?
Two buys again, but from the mid-cap side. First is a buy on Mahindra and Mahindra Financial Services. The stock over the last 1.5 2 months has been in the range of 220 to 245. Yesterday also the stock came very close to 245, which is the breakout point. That has been tested 4 times. So on dips to 230, this becomes a risk-reward trade, wherein it can eventually break out about 245 and head up to 260 levels. A stop loss at 224 and a target price of 260. Second is a buy on Ashok Leyland. We've seen good momentum across the tractor space. We've seen Mahindra and Mahindra make a new all-time high. Ashok Leyland is something which is testing that 152, 153 mark for the last 3-4 months. Yesterday also it came very close to that 153 mark, pulled back a little. Out here the stock has made a bottom around 144 for the last week or so. So a risk-reward trade here also. Once it breaks out about 153, I would expect a quick move to 170. So buy with a stop loss at 144.
Naresh, if you let me just make this one observation on days when, there's expected to be a lot of volatility and pressure. You've always gone defensive with NTPC, Power Grid, etc. You're not expecting that kind of a day?
So now the event is over. Now one can trade much more clearly.
Let's bring you up to speed with news outside of the budget and what we saw yesterday on the Adani group of stocks as well. We're going to talk about Jubilant Food now. If you look at the third quarter performance, well, if you look at the profit, that's actually seen a 36% fall to come in at 88 crore rupees. This was 137 crore rupees a year ago. Also missing estimates when it comes to margins, and revenues seeing an uptick of about 10%. That's how the stock did yesterday, down by about 6.5%. Now, what's interesting is that Morgan Stanley remains overweight on Jubilant Foodworks, even as it flags off near-term demand weakness. My colleague Vinny joining in live to bring us up to speed with this. Good morning, Vinny. So what's making Morgan Stanley so jubilant about Jubilant?
Absolutely. When you look at Morgan Stanley's report, yes, they're still maintaining that overweight rating, but do not forget, because they've cut their target price coming in. So now the target price is at 560 rupees. Previously, it was 624 rupees. Now, yes, there was a weak performance that came in Q3 from the company. Negative operating leverage is actually something that hurt the margins of the company. And what Morgan Stanley is highlighting is the near-term demand weakness also seems to be continuing for the company. And one key factor is that, what the company has actually highlighted, a decrease in value proposition of a Domino's brand in consumers' mind is a key factor that they have highlighted in the report, and this is coming in from Morgan Stanley. Now, Macquarie too is actually maintaining their underperform rating, and they too have cut their target price by around Target price coming in at 380 rupees versus previous target price of 445 rupees. They're also cutting their EPS targets as well. And obviously what Macquarie is also saying that the stock has actually failed to price the limited visibility on demand and margin recovery, and risk of an elevated capex outlay is a concern that they are flagging off as well. JP Morgan too is actually maintaining their neutral rating and have cut their target price as well. So we are seeing target price cuts coming in from most of the brokerages for Jubilant Food work. So that's an important factor to watch out for. But let's go across and listen in to Samir Khetarpal, who's actually highlighting some of the consumer trends, that how they're gravitating towards the lower price point, and that is a very key important factor that indicates about the consumer trend as well. Let's go across and listen in.
The focus area is dine-in, and customers at this high inflationary environment, they're making choices. And we do see customer come with a total bill or total amount in a mind and a total quantity, and therefore they tend to gravitate towards lower price point. So as we are kind of competing for new customers, we believe given our scale, our ability to deploy technology, our reach of stores, we can actually capture that demand if we have a very strong 49 rupee price point menu, and that is where we are doubling down on. It is not that the customers that is a challenge. Again, I'm pivoting and saying that if we are the only ones who can offer a 49 rupee menu, then we should be acquiring customers at a faster rate, and that is what we are correcting in our marketing communication.
At this stage, we would not like to take any further price increase, and we would like to continue to drive value proposition because the focus would be more on bringing volume and growth back to the levels that we were anticipating, and not really take up prices at this moment.
All right, let's shift gears then and focus in on the entire insurance space. Macquarie has found the likes of SBI Life and ICICI Pru attractive within the insurance basket. But let's find out what their views are on the rest of the space, especially in light of what was announced in the budget. Harsh is here with all those details. Harsh.
Well, yes, Savanya, looking at largely the larger basket of insurance products being impacted by the change in the budget. And let's talk about that. What Macquarie is saying is that for ICICI Pru, it's less than 5% of the APE, which really essentially comes from these high ticket policies. For HDFC Life, it's more than 10% of the APE that could be affected going forward. And for SBI Life, the APE is less than 1% of its total APE component. Now, with regard to SBI Life and ICICI Pru, both took sharp knocks in trade yesterday, and that Macquarie suggests is making them an attractive buy. LIC may also, of course, have a target segment which essentially is looking for that ATC deduction, which also is indicated that is going to get phased off, and with the 7 lakh limit coming in for individual taxation below 7 lakhs not taxable or rather eligible for tax rebate, that may also be a key negative to start off with for LIC, and therefore that could impact LIC premiums going forward. So those couple of moves coming through, and that's what Macquarie believes on the insurance space.
Okay, so that was one of the announcements in budget 2023. Details as always in the fine print, and that's why in the last half of trade yesterday, once the markets got to know about this proposal, you did see the insurance stocks take it on the chin. In fact, that's putting it rather mildly. If you look at HDFC Life, that stock was down nearly 11% in trade. And now we have the top management, the MD and CEO here with us on the channel, Vibha Padalkar. Always a pleasure talking to you. Thank you so much. So we saw yesterday what exactly happened with the insurance stocks. This is, of course, now it will be taxable for all policies after 1st of April 2023, above 5 lakhs, non-ULIP. You'll see that tax kicking in. What's going to be the impact on HDFC Life?
I believe that once the news is digested, I think that the sector is resilient enough to tide over this, and I'll give you some of the data points. One is that a quick look at our own numbers, probably it will have maybe a 10 to 12% impact on the top line and significantly lesser on the bottom line. And also this assumes that we are going to be where we are and not take any definitive steps to bridge the gap. Some of the steps that we will take virtually immediately are as follows. One is that to look into a lot more in terms of focus on acquiring new customers rather than only the ticket size growing. And that used to be really how HDFC Life did things not so long ago, before the whole ticket size increase started happening, because the products were attractive and people were willing to allocate more money to it. So going back to basics on increasing the number of policies being sold so that ticket size is still within the 5 lakh limit and you're selling more and thereby deepening the insurance penetration. That is number one. Number two is that our focus on tier 2 and 3 towns. As you know, we recently had a acquisition for precisely this reason of how do you penetrate more away from the bigger ticket, more salaried, affluent metro to the tier 2 and 3. So some of these things will help us in terms of bridging the gap, the 10 to 12% gap. And lastly, I think that the reason why people were buying some of our products, flagship products in this segment, was not only for the tax-free aspect of it. What was equally important is that these products were giving them a longer-term guarantee, especially in their golden years. And that will still be there because the product contours will not change. And so my belief is that once the initial noise dies down, people will say that, okay, now I have more disposable income in my hands thanks to what the Honorable Finance Minister has rolled out today. As a result of more disposable income in my hands, where do I invest this money? And ultimately, money will get invested somewhere or the other. So as long as we are more competitive or reasonably competitive versus where money could otherwise be deployed, I think some of this clawback of the loss in top line will certainly start happening.
Vibha, hi, morning. Now, what is the percentage of the customer whose premium is more than 5 lakhs per annum for HDFC Life, and what is the impact of the new business premium?
That's why I said about 10 to 12% at an overall company level.
All right, fair enough. And what about the kind of margins these higher premium policies like for HDFC Life? Can we say going forward that the companies, will have an impact on their new business margin also?
Actually, it's the other way around, which is why I said on the premium, new business premium, it has about a 10 to 12% impact. But on the margin, it has a lesser impact, lower impact. And one of the key reasons is that the higher ticket policies are typically lower premium paying term. The PPT is lower. Typically, it would be maybe 6-7 years, between 5 and 7 years, that kind of a range, as against the lower ticket size, which would be for the next 7 to 10 years. The 7 to 10 year policies definitely have higher margin signature. And so impact on margins is lesser than impact on the rupee value of top line.
Now, Vibha, as we all know, this kicks in from 1st of April 2023. We've had the CBDT chairman, Nitin Gupta, also say that right here on ET Now. So just what is it the markets can expect? Will insurance players now focus in this quarter, the January to March quarter, therefore, to pick up on sales, because we're not going to see that tax kick in, focus on premiums above 5 lakhs, the high value ones. Is that how it's going to pan out? And then let's not forget, going forward, there will be that higher base effect at play too.
More than the companies wanting, I think there will be a pull of the market. Customers will absolutely want to lock in because this window period getting over. So you'll see a lot of that in the next 2 months.
Okay, so that window is, of course, getting over, so it is expected. Now, in the union budget, what we've seen is a lot of focus and relief for the new income tax regime. Otherwise, not many incentives for deduction. How will all of this really pan out? And can this be seen as a negative for life insurance companies?
Yeah, given the customer profile of HDFC Life, and we just now talked about on your show about how the mass affluent and affluent will get impacted and so on. So the average ticket size being about 1 lakh, anyway, ATC has been fairly crowded over the last several years. Anyway, ATC was not increased in line with inflation. So tax has never been the primary driver in our case for our customers to buy our policies. And so we don't really see any material impact of that impacting as people move and graduate to using the new tax regime. Another data point is that the business that we have been doing in quarter 4 has progressively been coming down to a more normalized level between the different quarters. So don't really seems that we should be worried on that count.
Right. Really appreciate your time, Vibha, and certainly hope to see much more of you going forward. There are two factors which are worth debating. Why did market, sold off yesterday, and who was the seller? FIs were buyers. The FNO data does not look bad. Domestic institutional investors were buyer. So what led to the market sell-off? And I think it was really technical in nature. The technical sell-off which happened, which got created because of sell-off in Adani group of stocks, had a domino effect. Markets in the short term, they can be fragile, and since there is a huge price dislocation which has happened in Adani group of stocks, that really had a very large overpowering role to play in the way how markets moved in the second half of trade. So markets saluted the budget, they reacted to the budget, and I think the minute the selling in Adani group of stocks started, let's actually look at it, Adani Enterprises and the Nifty intraday graph, and you would see a big similarity there, big similarity there. The other question is that why are foreign institutional investors selling? Is it just a transient phase where money is moving out of India to China, and is it something which in a sense will really abate going forward? And we spoke to Vallabh Ansari precisely on that point, that how long foreign institutional investors will sell and when will they come back?
The number to see for us is going to be FDI. And as long as that FDI, and we're already seeing that big players who write hundreds of millions of dollars of checks are looking at India very positively. And I think what we are losing in terms of FII to some extent will be MIG. And those flows are very volatile. We know that they go very quickly and they come back very quickly. So I think 2 quarters of great performance, that money will start coming back to India. And that will fit into, it will get synchronized into the interest rate cycles in those countries, performance in India, etc. So I think there are many stories where, either there are unique problems like a merger or a succession, etc. We have seen tremendous resilience. Through all this, flows into mutual funds and SIP are continuing. Flows into insurance companies are continuing. So I think it's something to observe, but not unilaterally that, foreigners are selling, so what will happen? I think the domestics are getting stronger by the day.
Dipen Mehta joins us. Dipen, good morning. FIs were buying, DIs were buying. Dipen Mehta, I'm sure, was buying yesterday. So kal becha kisne? Markets fell.
Yeah. Good morning, Nikunja, and thank you for having me on your show. And I just heard you a few moments ago about how you described the market and why actually it fell. But I just want to, discuss a very important point over here. That is the role of the day traders. See what happens. None of the Adani Group stocks are in trade for trade, and the lower circuit is anywhere from 10% to 30% or so. And when a day trader sees this kind of a momentum fall, for example, if he sees a stock is down 1%, then it goes down by 2%, and then by 3%, that becomes a perfect trading opportunity. And the volumes also were phenomenal in those counters. So all that the day traders did is they just shorted the Adani Group stocks during the day, and they covered it before the close of the market. And this is not just done by humans, but a lot of it is being done by algos as well. And people who have got servers at NSE's data center, they're able to capture the prices over there, and there are specific strategies written that when a stock is down by X% and the volumes are so high and certain intraday charts give the signal, then they proceed to sell. And that also has been a big factor in these stock prices selling off the way they have yesterday. But apart from that, I think there is no real explanation. And also, I know that FII's figure has been generally positive. But Nikunj, whenever FIIs sell, no, they sell with such vigor and they sell in such a way that they want to exit that stock or that counter right away, right now. So they are basically the price makers. And when you have some concentrated selling coming in from a few FIIs who want to sell at any price in the next 1, 2, 3 hours or so, then you have such price corrections. And even though buyers want to buy, when they see so much of selling pressure coming in, then they try and put their buying limits lower and lower. At the end of the day, what you have is a correction in the market, what we saw yesterday.
When do you think markets will settle? If the budget is so good, and if directionally we know the economy is headed, it's a matter of time that the buyers will be back.
Yeah, right. I think it's just a matter of time. And, I think once stability comes back to global markets, I think, and once this Adani issue goes to the background and is not hogging the limelight as it is just now, I think eventually the fundamentals will start to get reflected in the stock prices. It's been a very good budget and the kind of spending which the government is undertaking and the way the money is going to go into the households for them to decide whichever way they want to spend, could be on consumption, could be on different savings products and not just the ATC products per se. I think it's going to have a multiplier effect going ahead. And on the whole, also the earnings season have been pretty decent. There were some fears as regards tech companies, but those also have been largely addressed. And on the whole, I think we are doing pretty well with very large sectors like real estate, automobiles, capital goods. After many years, we are seeing a good turnaround in these sectors, and these have also key from point of view of the feeders or the raw material sectors which supply to these large growth sectors. Also, those should also do very well. So I'm very optimistic and positive on the medium to long term. And I don't know what will happen today. The SGX Nifty showing a correction, and maybe it will. But I think this is a good buying moment, and 2-3 quarters down the line, maybe end of this year, early next year, we should see decent returns coming through across Indian equities.
Okay, how do you see Adani Group of stocks moving, Dipin? I know you don't track them. I know you don't track them, but still, I'm sure you have a view.
See, I'll tell you, in the 30 years I've been in the market, whenever there's so much of controversy around the stock, right or wrong, we are not going to give a judgment on that. I think that the regulators and the management, will eventually do what they have to do, and we will have an outcome either ways. But whenever there is so much of, controversy, so much of news flow, this kind of concentrated selling coming through, I would say from a conservative investor point of view, and I'm talking of investors, not traders. I mean, for traders, this is a golden opportunity. You could buy Adani today and hope it goes up by 500 rupees in 2-3 days or so. But from an investor's perspective, I think it's better for the dust to settle down, see where the valuations are actually, getting resting at, and then perhaps take a call. Because businesses per se are decent, the companies have made great progress, and it's just that the valuation from an investment perspective was on the higher side when compared to the peer group, which is why many investors did not invest in the Adani Group companies. But now that we've seen such a serious correction, and then of course the earnings over the next 2-3 quarters also will lead to higher earnings per share. So we are seeing is the PE compression in the Adani Group companies, and at some point of time they may make a very interesting investment opportunity. But for the time being, I think while there is so much of news flow and while there is so much of selling pressure, it's best to just stay on the sidelines and then let the dust settle down and then look at buying these companies if at all.
And Deepan, is this going to be a rationale also for, let's say, an Ambuja as well as an ACC? We've seen the clarifications that have today come out from the Adani Group as well. Because if you look at it outside of that, yesterday the cement pack was having a good day in trade for obvious reasons, given all of the announcements, etc.
You're right. I think if you had to buy certain stocks in the Adani Group companies, then ACC and Ambuja, the way they have corrected, would be the first of the block. They have been around for a long time, and it's very easy to value these companies. We have got a lot of comparables, and they have a great track record, multi-decade track record, and everybody understands the cement industry really well. But my personal view on the cement industry is negative, which is why I wouldn't like to buy any cement company, not just ACC and Ambuja. But I feel that there are structural changes taking place within the cement industry. Company after company is looking at doubling its capacity over the next 3 to 5 years or so. If not doubling, 30-40% higher or so. And what we are seeing is that's going to cause a glut in the next 2, 3 years or so. And the kind of price discipline which the industry had for so many years, that's getting vitiated. I mean, look, see the last 2, 3 quarters or so, we've seen increases across the board for all inputs for cement, be it power, fuel, transportation, raw materials. And yet these companies have not been able to pass on these cost increases, the input cost increases, and they have just absorbed it. And we have seen a sharp decline in the operating profit margins of the cement industry. And that shows that clearly the pricing pressure, the pricing discipline is not there anymore. There's pricing pressure, and that will continue for a long, long time. So I'm very negative on cement. I think it's a good time to buy the cement consumers. You know, real estate is doing really well. We spoke about capital goods, but entire infrastructure, engineering, construction companies, I think, which all consume large quantities of cement. I think they are in a very sweet spot at this point of time. And we saw the kind of encouragement being given to planned spending. I think 35% or 33% higher capex by the government is phenomenal. It's going to have a huge impact, positive impact on engineering construction companies. So I think that's where the focus should be, rather than cement, which is typically a commodity, and now it's getting a very, very crowded space in terms of higher and higher install capacity.
To go, and what are we working with? We are working with the SGX, which is indicating that markets may be in for a flat to a downward start. Naresh, Kunal, let's discuss the strategy for the day. Post budget at 1:30, it appeared that markets were getting ready for a launch. I mean, the launch pad was just about getting ready. We had come on the right side of the event, so to speak. But in the last 1 hour of trade, the market reversed completely. What should a day trader do? Anticipate a further decline or prepare for a smart short covering rally? Kunal, Naresh, anybody can start.
So I'll go first. Nikunj, I believe that the latter is more probable as well as a possible trade, that you have to go in for a short covering expectation over here for the indices. And as I mentioned yesterday, major sell-offs and panics, they generally happen when there is a sentimental based selling which happens. And yesterday was one of the days when you saw just one group of stocks being one of the major reasons why the markets went into more of a sentimental sell-off. Now the other data which I'll throw is very, very intriguing. So 2 days back, I think on 29th or 30th of Jan, when the markets made a low at 17,400 levels on an intraday basis, the market breadth was extremely oversold. Now yesterday we went further below the 17,400 mark, and I think it's not just the dip below the 17,400 mark, the manner in which we corrected below the 17,400 levels. But apparently the market breadth was much better than what it was 2 days back when the index had hit that 17,400 levels, which means that the market breadth is being more resilient even in these kind of turmoil. So I think that's a strong indication that the markets are setting up a stage for a major bottom formation over here. So my strategy is to use these opportunities of 150 odd points dip.
Will you press a buy?
Absolutely, yes.
And will you buy more than what you normally buy when you trade?
Yeah, I think it's if we actually open at 150 points gap down, which I frankly think it should not, I think it's a good opportunity to go long.
Naresh, Kunal feels that it's a day to buy Nifty or Bank Nifty. That's a matter of choice. But he also feels that one should be buying significantly higher quantum in normally one actually does. What's your view?
So the view is same, 150 to 200 points down. If we gap down, we buy more. It gaps down 200, 250, we buy more. So that's the view, because that is where the risk reward becomes more and more interesting. Yesterday's low is say 17,350. So you want to buy it 100 points closer to it. You want to buy 150 points closer to it. So as closer to 100 points, you add up more quantity. So the risk reward is good, because the possibility is the upside back to 17,900 to 18,000 eventually. So I would be a buyer if there is a bigger dip. If it's opening flat, the trade becomes much lesser quantity.
Okay, a lot of things on our radar this morning, not just the Adani FPO, which has been called off. The statement is saying that they don't have big pledge on ACC and Ambuja. So in particular, look out for both those stocks. And of course, Adani Enterprises, given that the stock is now sub the FPO price. That said, a lot of other things as well happening in the world. Fed says no rate cuts for 2023. You've got Brent, which is down a good 3%. No change in OPEC, but inventories have been on the rise. And then, of course, the post-budget reaction. You're going to see what happens in some of the defense names, capital goods names, and whether the reaction in some of the insurance stocks, that continues or not. And Kunal, the one stock stock that I want to pick up from within the insurance basket, HDFC Life, the way it cracked yesterday, over 11% on the futures. Do you see more pain coming in?
Yeah, I think there should be more pain for the stock. In fact, what actually intrigued was the correction in the likes of SBI Life. Of course, most of the insurance stocks would probably take a beating on such kind of a day. But then I think SBI Life has been one of the most stronger ones. HDFC Life apparently has been one of the more weaker ones from the insurance pack. So when you look at the last 1 year of price action data, the three stocks which we typically tend to compare, SBI Life, ICICI Pru as well as HDFC Life, and these three are ranked in a very similar kind of a manner, where SBI Life was one of the best performers, ICICI Pru was more of a moderate performer, but HDFC Life was one of the weakest performer. In fact, the stock is now on the verge of making a fresh 52-week low as well. So I wouldn't be surprised that the stock actually continues to see more selling pressure even going forward.